What is the price-to-sales ratio and what is it used for? Well, the price-to-sales ratio is generally used for companies that don't have any earnings. In other words, companies with a lot of sales but after expenses, they are at a net loss. That's when the P/S ratio can help. It can compare other companies in the same financial situation within the same industry. The price-to-sales ratio shows how much the market values every dollar of the company's sales. For example, if a company isn't earning a profit yet, investors can look at the P/S ratio to determine whether the stock is undervalued or overvalued. If the P/S ratio is lower than comparable companies in the same industry that is profitable, investors might consider buying the stock due to the low valuation. Of course, the P/S ratio needs to be used with other financial ratios and metrics when determining whether a stock is valued properly. The P/S ratio is calculated by dividing the market capitalization of a company by its total revenue over a specific period. The formula is as follows: P/S ratio equals market capitalization divided by total revenue. The P/S ratio is often considered a more reliable valuation metric for companies that are not yet profitable, undergoing growth, or experiencing earnings volatility. It can be particularly useful for evaluating startups, companies in emerging industries, or those with inconsistent earnings patterns. Here's how to interpret the P/S ratio. A low P/S ratio may indicate that a company's stock is undervalued relative to its sales. This could suggest a potential investment opportunity, especially if the company's growth prospects are positive. A high P/S ratio may suggest that a company's stock is overvalued compared to its sales. This could mean that investors have high expectations for future revenue growth, even if the company is not currently profitable. Well, what's considered low or high? It all depends on the industry the company is in. Generally, anything below 1 is considered undervalued and above 2 is usually overvalued. But this is not set in stone. For example, a 2 might be considered low in the restaurant industry, but high in the wholesale food industry. Comparing a company's P/S ratio to its peers within the same industry can provide valuable insights. If a company's P/S ratio is significantly higher than its competitors, it might indicate that investors are willing to pay a premium for its sales, possibly due to strong growth prospects or a unique market position. The P/S ratio can reflect market expectations for future growth. A high P/S ratio might be justified if the company is expected to experience substantial revenue growth in the coming years. It's important to note that the P/S ratio does not consider a company's profitability or expenses. It focuses solely on the relationship between market capitalization and revenue. Additionally, P/S ratios can vary widely between industries, as some industries naturally have higher revenue levels than others. While the P/S ratio provides valuable information, it should not be used as the sole metric for investment decisions. It's recommended to use it in conjunction with other financial ratios and qualitative factors when evaluating a company's financial health and investment potential. In conclusion, the price-to-sales ratio is a useful tool for assessing a company's valuation in relation to its revenue. Investors use the P/S ratio to gain insights into market sentiment, growth expectations, and industry comparisons. However, like any financial metric, it's important to consider it alongside other factors when making investment decisions. Well, that's it for today. If you enjoyed this video, please smash the like button, comment below and subscribe to this channel. Until next time, happy investing!